Interest rates, nominal versus real, inflation adjustment. John is sitting in his workshop, feeling like a financial genius. His business bank account is earning a steady 8% interest rate, and every month he sees the balance tick upward. In his mind, an 8% return means he is getting 8% wealthier every year. He imagines that in 10 years, his keyboard empire will be significantly larger just from the interest alone. However, as he heads to the local electronic supplier to restock on high-end mechanical switches and aluminum frames, he notices something troubling. The price tags have changed. A set of switches that cost him $100 last year now costs $105. The lunch he buys at the corner cafe has gone from $10 to $11. John starts to feel a sense of unease. He realizes that while the number of dollars in his account is growing, the stuff those dollars can actually buy is becoming more expensive. He is experiencing the invisible tax of inflation. As Brealey, Myers, and Marcus explain, a bank fixes the number of dollars it pays you, but provides no assurance of how much those dollars will actually buy in the future. To truly understand his wealth, John needs to look past the surface and distinguish between nominal and real interest rates. The interest rate the bank quotes to John, the 8%, is what we call the nominal interest rate, is the rate at which the number of dollars in his account grows. But John doesn't care about paper or digital digits. He cares about his purchasing power. If the general price level of goods and services is rising, his purchasing power is eroding. This general rise in prices is known as inflation. Economists track this using tools like the Consumer Price Index, or CPI, which measures the cost of a typical basket of goods. To find out how much richer he is actually becoming, John needs to calculate the real interest rate. The real interest rate is the rate at which the purchasing power of his money grows. If John's nominal rate is 8% and the inflation rate is 5%, he isn't actually 8% wealthier. He is only about 3% wealthier in terms of what he can buy. The simplified formula that John can use for a quick check is the approximation. Real rate equals to approximately nominal rate minus inflation rate. However, professional financial managers like the ones Brealey, Myers, and Marcus describe use a more precise calculation. To be exact, the relationship is 1 plus the real rate equals 1 plus the nominal rate divided by 1 plus the inflation rate. When John plugs in his numbers, 1.08 divided by 1.05, he finds that his true real return is approximately 2.857%. This is a massive wake-up call. His 8% growth is actually less than 3% once the cost of living is stripped away. John realizes that if inflation were to spike to 10%, his 8% bank account would actually be making him poorer every year. Even though his balance would go up, he would be able to buy fewer keyboard parts at the end of the year than he could at the beginning. This leads him to a fundamental principle of finance known as the Fisher effect, named after the economist Irving Fisher. The Fisher effect suggests that nominal interest rates tend to follow inflation. When investors expect inflation to rise, they demand higher nominal interest rates to ensure their real return stays positive. This is why, during periods of high inflation, you will see bank rates and bond yields skyrocket. Not necessarily because the economy is booming, but because lenders are trying to protect their purchasing power. Understanding the difference between nominal and real values is the X-ray vision of financial management. It allows John to see through the money illusion, the tendency to think of currency in nominal terms rather than what it can buy. When John is planning his business goals for the next 5 years, he no longer just targets a dollar amount. He targets a real value. If he wants to buy a new 50,000 3D printer in 3 years, he knows that the printer will likely cost more than $50,000 by then due to inflation. He must discount his future needs and his current savings using real rates to ensure he isn't left short. This lesson changes how John views every contract and every investment. When a client offers him a long-term payment plan, John doesn't just ask about the interest rate. He asks himself what he thinks inflation will be over that period. He knows that in the world of corporate finance, you must always discount nominal cash flows by the nominal cost of capital to stay consistent. By mastering the math of real versus nominal, John ensures that his business engine isn't just spinning its wheels, producing more paper dollars while losing actual ground. He is now building wealth that is measured in real assets and real power, not just in the fluctuating numbers of an inflationary world. As he heads back to his workbench, John feels more in control than ever. He knows that the true measure of his success isn't the size of the check, but the strength of what that check can build.